earnings seasons continues, and today under the spotlight we have Novo Nordisk, the pharmaceutical giant. Now, they did report their earnings before market open and they are down nearly 8%, and in fact over the last month they are down 16%, now trading in the midpoint of the 52-week range. Now, when we take a look at their earnings at a very high level, we can see their shares did drop as they in fact posted an earnings miss, and couple that with an operating profit outlook that has been cut does not look too good for investors. Now, we'll take a look at some of the numbers, but we can in fact see operating profit has now come to around 20 to 28%, which you could argue firsthand does still look to be very strong, but bear in mind this is a company that does trade already at a very rich valuation, as that is why we have now seen the share price come down. So in terms of the numbers, well, net profit came in at just over 20 billion, and we can in fact see here that the market were anticipating around 20.9, so unfortunately that was a miss straight off the bat. The second one, the EBIT, earnings before interest and tax, 25.93 billion, and in fact again another miss under the 26.86 that the market wanted to see. Now, as we mentioned, already fairly high as it was, the operating outlook for the full year is now looking to be around 20 to 28%, and in fact it was previously at the 22 to 30% level, so a very small look, but again the market does not like to see this for a company that does trade at a very rich valuation, which we will come to look at when we put it through our own valuation model. One thing to note, however, we did see the net profit is increased around 28% when we look at it on a year-on-year basis, and whilst they have cut the operating profit outlook, they in fact increased their top line revenue for the full year around 22 to 28%. As we can see previously, this was sat at 19 to 27. So before we look at the underlying metrics of this company, let's just point out from their own investor presentation how good these numbers were. Now we're comparing the first 6 months of 2024 to the first 6 from 2023. We can already see their top line at 133 billion is up around 24%, so that is off to a great start. As we said, they are expecting in the 20s for the full year of 2024. Gross profit also up, as we can see, by the same percentage, 24. And when we look at the operating profit, looking very healthy, 57.78 billion, and whilst that is up around 18%, one thing that we do have to point out, the operating margin is down 43.3% versus the 45.4% that we saw from last year. In terms of the bottom line, 45 billion, and that is up 16%. And also we can see their earnings per share, 10.17, up from 8.71, around 17%. So the numbers do tell us this company does continue to grow at the double-digit rate that we expect. And then when we do move on and take a look at capital allocation, this is one thing that I would advise when you're looking at any companies you hold or are considering. Always see the way that they do use that capital allocation. So a few things that Novo Nordisk do is in fact the return of free cash flow through those share buybacks and dividends, something that we talk a lot about on this channel. Very nice to note. We'll cover this shortly, but they did increase the dividend at a very rapid rate, 51.6%. And what they have also pointed out is they are going to continue that repurchase program for 2024 up to around 20 billion Danish kroner. Now, in terms of the year-on-year movement, what we are noticing is that the share repurchase estimated for 2024 is going to be at the lower end of the last 4 years. Nonetheless, one thing that we always like to see are those dividend increases, and that is something that they continue to do over the last few years. Always worth looking as well at the financial outlook for these companies. As we mentioned, their top line, they actually increased their guidance from May just today, 22 to 28%. As we can see, expectation 19 to 27. So it is an increase, although fairly marginal. What we can see in terms of the operating profit growth, they have lowered that again, as we saw the massive headline and operating cut, 20 to 28, down from 22 to 30. And the final thing that we like to point out, as it is very important, not just to us when we look at companies, but also our valuation, is that their free cash flow has increased from the 57 to 67 to the 59 to 69. Now, as a quick recap, yes, this company is down around 8%. It is also down over the last month. Year to date, however, it is up around 16%. Over the last 12 months, up 48%. And if you've been a long-term shareholder, this is up 437% over the last 10 years, significantly outperforming the S&P. Now, as we mentioned, it is in the midpoint of the 52-week range and does trade at a fairly high forward PE. Now, it's around 38.5. Bear in mind, though, it has just dropped today, and it is still a buy for Wall Street with a hold from Seeking Alpha and Quant. And whilst it does have a lower yield than maybe what we want to see on the channel, 1.05%, we're now going to take a look. And as we already mentioned, they did increase that by 52% over the last full year. In terms of dividend safety, well, a 99 score, very safe, in fact the highest score obtainable. What this ultimately means is that a dividend cut is highly unlikely. Now, for those that see a recession inbound, in the Great Recession 07-09, they actually increased the dividend. They had plus 6% sales, which was well above the average of the S&P at negative 12, and they also significantly outperformed the S&P's total return, negative 27, with the S&P coming in negative 55. One thing we love to see here, double-digit increase over the last full year, over the last 5, as well as the last 20 years. This is definitely one of those very strong dividend growth companies that not only increase the dividend at a rapid rate, but also, as we saw, outperforms the S&P. They also have dividend aristocrat status, 25 plus years of consecutively increasing those dividends. And one thing we do like to look on this channel is dividend yield theory. Now, what it states, company is undervalued when the current yield sits above the 5-year average, so you could argue overvaluation based on this model. However, on the forward PE sitting around 31, it isn't dissimilar from the 5-year average of 30, so reasonable valuation based on this. And when we look at the healthcare, well, the sector as a whole sits much lower at 16.6. Do always bear in mind, though, we don't look at any of these models in isolation. We will conclude when we come towards our valuation model. Now, free cash flow below 60% is what we want to see. Give us faith they can continue to offer double-digit increases. Over the last 10 years, it does straddle around that amount. Nice to note, over the next 12 months, 58%, so we should expect again for the next year some nice increases. We then move on to the free cash flow per share. We want to see consistent increases over the longer term. It has pretty much tripled over the last 10 years, 1620 over the next 12, so it is anticipated to continue the upward trend that we really want to see. Sales growth, as we mentioned, a company that has increased a double digit over the more recent period. 2024 as well in the 20 to 30% region expected, so that is also very nice. But again, you want to keep an eye on that, because if that does start to lower, that will ultimately affect the valuation, as it is priced in at a fairly large PE in comparison to the healthcare sector. Numerically, we'll look at this, but we can in fact see more than doubled over the last 10 years. And also nice to note, for a company that has a dividend, increases at a very nice rate, they do return excess cash to shareholder pockets through those share buybacks. We then move on to the ROIC, one of my favorite metrics, and this company probably has one of the best numbers that we have seen on this channel. Remember, we want to see 10% or more. Give us faith, management are able to effectively allocate their capital. Just look at this. Honestly, let me know in the comments below if there are any other companies that come anywhere near as strong as this. 72% in 23, 82% on a trailing 12-month basis. This is absolutely fantastic. Talking about fantastic, well, the margins looking very strong. Above 12% is what we want to see at a bare minimum. 39 in 2014, 45 in 2023. So we get a first glance of their operating efficiency increasing over the longer term, and a pure free cash flow machine above 5% every single year. And we're talking about nearly 30% plus over the last 10. So looking great. And then we get to the net debt to EBITDA. If you thought this company's metrics couldn't get any better, well, just wait. Earnings before interest, tax, depreciation, amortization, below 3 is what we want to see. Remember, these numbers below correlate to the number of years it would take the company to pay off all of its debt net of cash on hand. 0.1 in 23, very low. 0.22 expected over the next 12 months, very good. Ultimately, remember, this correlates to balance sheet strength and dividend safety, so we have a very safe dividend score, and the balance sheet, as we're about to find out, looks very good. Also, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, do click on that pinned comment below where you can sign up and read straight away. We also have our list of 35 undervalued stocks that you can get access to, and we run through every single one, a lot of numbers, why we like them, and also ultimately which ones we hold. So let's have a quick look at the income statement. Now, we did talk about the revenue. We love the growth. In fact, more than doubled over the last 10 years, 14 to 34 billion, and we can see the sheer consistency due to those double-digit increases that are fairly consistent. But our ultimate takeaway from this is, what does the bottom line show us? Is it a very similar trend? Well, the answer is fairly simple. Yes, 4.3 billion in 2014, 12.4 in 2023, so 3 times growth. And as we can see, for the large part, it is fairly consistent and moving in that right direction. So that is very nice to see for shareholders as well as those that are considering adding this company. Then we move on to the health of the company, looking at their balance sheet, total cash versus total debt. 2.6 billion in 2014, 1.3 in the latest report. So it has dropped slightly, but we do know fairly inconsistent over the longer term. And remember that this number in isolation doesn't really tell us anything, which is why we always compare it to the total debt numerically and directionally, going from 117 million to just under 4 billion in that report. So we can see, unlike the cash, which although inconsistent has decreased over the longer term, the total debt, again fairly inconsistent, but has increased. Now we did note when looking at the net debt to EBITDA, it is fairly low, so it does look fairly decent based on the information we have just gone through. Now, how have they performed historically? What are expectations moving forward? Well, very nice to note, over the last 3 quarters, they have beaten on the EPS. What we also note, over the next 3, they are anticipating growth double digits, and if they do hit their December 2025 EPS estimate, the forward P will come down to around 31. Now, this will depend on whether or not you believe they can hit these numbers, as when we did take a look at some of the numbers from their report, they did come under and they did cut on the operating profit, but nice to note, as we said, the revenue does look to be increasing in the guidance. So let's look at some underlying metrics, starting off with the valuation. No surprises at all, they get an F. As we just saw, it does trade at a richer valuation, quite significantly than the sector. In fact, a P on a non-GAAP basis around 38 is well above the sector median of 21, essentially telling you as an investor, if you are buying this company right now, you are paying an 87% premium against the market, and no surprises on any other valuation metric that you do use, that is the same information, hence why they get the D and the F, and we can clearly see a very large premium. Now, sometimes it is justified that these companies do have a premium. The question is understanding how much should we pay, and again, that is where the valuation will come into shortly. But look, A- on the growth, ultimately telling us the growth is a lot better than the sector, 30% versus the median of 7. When we look forward basis, 25 versus the 9 that we can see for the sector as well. And the main thing I want to draw your attention to here is that over the next 3 to 5 years, EPS is anticipated to increase by 16%, where we have the sector as a whole just under 12. Again, information just to consider when we are wondering why this company is valued very richly. We then get to the profitability, again another reason to understand why at an A+. Phenomenal margins, 85% against the 57 sector median, 36.5%, when in fact the sector as a whole hasn't been doing too great, -5%. Now the last thing that we want to talk about here is the cash from operations, 13.51 billion, again negative for the majority of the sector. In fact, sector media sitting at -16 mil. As a quick wrap up to this part of the analysis, a buy from Wall Street, a double hold from the other analysts, an F on valuation, A- on growth, and an A+ on profitability. So let's have a quick look. How have they performed against others in the sector? We have Eli Lilly, Johnson & Johnson, Merck & Co. The majority of these we have covered on the channel already. Now, over the last year, we do see NVO the second best performing, although they are quite some distance behind Eli Lilly, which is up 71%. Remember, total return includes reinvesting those dividends. Again, pretty much the same story to be said. Eli Lilly right there in first place, but NVO doing very strongly and a massive gap against the other companies. When we look over the last 10 years, again, we see something very similar. And as fantastic as this may be for NVO or LLY investors, remember past performance is not an indicator of future performance. Also, one thing that we just want to bear in mind, we're going to show you here, is going to be very obvious, but NVO has outperformed the S&P over the last year, over the last 5 years by quite some distance, and over the last 10. But this should ultimately be a question you ask yourself as an investor, whether it's this company or another. Do I believe it will outperform the S&P? If the answer is no, as always, do look at some low-cost ETFs. Now, final thing before we jump into the valuation model, institutional movement. Well, the ownership sits at around 12%. We've seen just under 2 billion worth of sales over the last year, with around 10.2 billion worth of buys. So significant amount of buys by institutions, more than selling. And also in the more recent quarter, Q2, we also see that 377 versus 303, and pretty much you'd have to go back quite some way, in fact quarter 2 of 2023, before we see the opposite effect. So yes, institutions are buying more, especially in the more recent quarter, but as always, do your own due diligence before jumping into any company and never follow anyone else's trade. So jumping into the valuation, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $124, how we've got to this, well, we want to show you so you can see whether you agree or not. We've run it through the DCF model where we have the free cash flow year on year, the growth rate. Now average growth rate has come to around 11%. We've gone for 3 different growth rates here, a low, medium and high, 10, 15 and 20%. We also just want to let you know, if you were to look at the last 4 years, the average would be sitting around 21%. So we've gone in today's episode at a medium rate of 15%, above the average, but as we can see, it is lower than the last 4 years as well as the last 2. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and there's that 124, which would imply 4% upside. Now you could say that is way too optimistic, do lower, 10% for example. So for transparency, we'll just show you at that 10% level, $87, which would indicate downside of 27%. Now again, others will say that this should be way higher, and therefore at that 20% level, it would show us 47% upside, 175 that we can see here. Now bear in mind, you can grab a copy of this model by clicking on the pinned comment below, running in your own numbers, whether it's for this company or any others that you own, or maybe you want to put on the watch list. So at the 50% level, that does give us the intrinsic value of 124, and this ultimately tells us that right now it isn't trading too far off the current price of 119. As always though, on this channel we like a margin of safety, 10%, and we use that if it hits our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, well, buy at $112. It isn't there yet, but it could be moving that way given the downward trend over the last month, as in fact we just saw it is down around 15%. Then we keep going just to see at what level you are considering. At 15%, 105. At the 20% level, you would have to wait around $99. Now, Wall Street, they don't really agree. They have a price target of 147. They see upside of 24% and do consider this a buy, as we saw from the initial rating. Now, if this was something that I would consider, it would be at least a 20% margin of safety around the $99, $100 mark. But as always, a lot of people will have different opinions, so do let us know your thoughts in the comments below. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to click on the pinned comment below where you can sign up to the free weekly newsletter, and also join us in the Patreon if you do want to run through our weekly buys and sells. As always, have a great day. We'll see you all in the next one, and for now, take care.